Welcome to NoPayNow Product Training. I'm going to start with a question. What if you told a homeowner they were sitting on tens or even hundreds of thousands of dollars, and the bank said they couldn't have it? That's the reality for millions of Americans right now. Here's the number that should get your attention. There is over $27.8 trillion in U.S. home equity sitting in American homes right now. That's trillion, with a T. In fact, over 110 million homes in the United States have 50% or more equity in their property. And yet, less than 1.5 million home equity lines of credit, known as HELOCs, are originated every single year. That is a massive gap between what homeowners have and what they can actually access. But why exactly is that the case right now? Because traditional options like HELOCs, cash-out refinances, and reverse mortgages all require things that many homeowners simply don't have. They require strong income. They require a low debt-to-income ratio. They add monthly payments. They add new debt. And for millions of homeowners who are equity-rich but cash-constrained, the door has always been closed. That is the problem NoPayNow was built to solve. In this training series, you're going to learn everything you need to know about the home equity investment, what it is, how it works, and how to explain it to anyone. So, let's get started with our first module. Now that we understand the problem, let's talk about the solution. The product is called a home equity investment, or an HEI. And the first thing I need you to understand and be able to say confidently to anyone you speak to is this: an HEI is not a loan. I'll say that again, it is not a loan. Here's what it actually is. A homeowner receives a lump sum of cash today in exchange for a share of their home's future value. That's it. Cash now, share of future value later, no monthly payments, no new debt. Think of it as a partnership between the homeowner and an investor. The homeowner keeps living in their home. They keep ownership. They use the cash however they want. And when they're ready, whether that's through a sale, a refinance, or a cash buyout, they simply repurchase the investment option. No penalties, no rush. Now let's talk about what makes this different from everything else on the market. This is what I call the NoPayNow promise. And these are the words you need to know by heart. No monthly payments, no new debt, no income requirements, no debt-to-income requirements, no age limit, and the homeowner keeps living in their home. This is not a loan. This does not affect their existing mortgage rate. This is a completely separate transaction. Here's what I want you to think about. When a homeowner hears those words, no payments, no debt, no income requirements, the natural reaction is, what's the catch? And that is the perfect opening for your conversation, because the honest answer is, there is no catch. There is a cost. The homeowner gives up a share of their home's future appreciation. But compared to taking on new debt, paying interest for years, and straining their monthly budget, for many homeowners, this is absolutely the better choice. Your job is to help them understand that. And this training is going to give you everything you need. Next, how the math works. All right, let's look at how this actually works with real numbers. I'm going to walk you through a real example deal so that you can visualize this. And more importantly, so you can explain it to any homeowner or loan officer in under 2 minutes. Let's start with a homeowner who has a home valued at $1 million. They have a mortgage balance of $500,000. That means they have $400,000 in equity. Now they want to access some of that equity. They come to us. Through NoPayNow, they receive an HEI of $100,000. Here's how the terms break down. The option to value percentage, or OLTV thickness, is 10%. That simply means the investment is 10% of the home's current value. The equity multiple is 2.0. This determines NoPaynow's share of the overall home equity. 10% multiplied by 2 equals 20%. So when this homeowner eventually sells their home or repurchases the investment option, NoPayNow receives 20% of whatever the home is worth at that time. The homeowner pays a one-time origination fee of $4,999. That's 4.99%. This is paid at closing. Now here's one of the most important features, the safety cap. The safety cap is set at 19.99%. What this means is, no matter how much the home appreciates, the homeowner will never owe more than 19.99% of the home's value at the time of repurchase. This is the feature that protects the homeowner if the market runs hot. Always lead with the safety cap when you're explaining this product. It builds trust. Now let's look at the exit. Let's say the home appreciates by 20% over 4 years. That takes the home value to $1,200,000. Without the safety cap, the uncapped repurchase amount would be $240,000. That's 20% of $1.2 million. But with the safety cap applied, the capped repurchase is $221,005. And here's the key rule: the homeowner always pays the lesser of the two amounts. So in this case, they pay $221,000, not $240,000. The safety cap works in the homeowner's favor, always. One more key concept: match term. The repurchase term runs as long as the homeowner's senior mortgage, with a minimum of 10 years and a maximum of 30 years. There are no early repurchase penalties. The homeowner can buy out the investment at any point within their term, through a home sale, a refinance, or a cash settlement. There is no clock pressure on the homeowner. That is a very powerful thing to be able to say. Next, eligibility guidelines. Let's talk eligibility. Knowing this information cold is what separates a great account executive from an average one. When an LO calls you with a scenario, you need to be able to qualify or disqualify it in 60 seconds. Let's start with the numbers. The minimum investment amount is $30,000. The maximum is $500,000. The property must be valued between $200,000 and $5 million. The minimum FICO score is 500. This is significantly lower than most traditional equity products, and that is a major selling point. Now here's the OLTV matrix. This tells you how much we can invest relative to the home's value and existing debt. For a FICO score between 500 and 539, maximum OLTV is 55%. 540 to 579, maximum OLTV is 60%. 580 and above, maximum OLTV is 70%. Remember, OLTV stands for Option Plus Loan to Value. That means NoPayNow's investment amount plus the existing mortgage balance divided by the property value. Now let's cover property types. We can work with single-family residences, or SFR, condominiums, townhomes, planned unit developments, PUD, 2 to 4 unit residential properties, and owner-occupied cooperative units. Properties we cannot work with include 5 or more unit multifamily, manufactured, modular, or mobile homes, houseboats, log cabins, geodesic homes, shipping container homes, properties on 5 or more acres, timeshares, and vacant land. If it doesn't fit the eligible list, it's a no. On the credit side, here are the key flags to watch for. Chapter 7. Bankruptcy. The dismissal or discharge must be at least 4 years ago. Chapter 13. At least 2 years from discharge or 4 years from dismissal. No foreclosures within the last 7 years. And no more than 2 NODs in the past 12 months. And no NOS in the past 12 months. Finally, we currently originate in Arizona, California, Colorado, Oregon, Washington, and 21 other states. If a property is outside these states, it is not eligible at this time. More states are coming. Next, the HEI process flow. Now let's walk through the full HEI process, from start to funded. There are 6 steps. Know them in order. When an LO asks, "What happens after I submit?" you should be able to walk them through this without hesitation. Step 1. Eligibility. Before anything else, the loan officer logs into the NoPayNow wholesale portal and checks the property's eligibility. This takes minutes. If the property doesn't qualify, you find out immediately. No wasted time. Step 2. Application. If the property is eligible, the LO continues the application inside the wholesale portal. They'll gather the required documents from the homeowner and submit the completed package to us for review. Documents typically include a government-issued ID, recent mortgage statement if applicable, homeowners' insurance declarations, and any other lien statements on the property. Step 3. Pre-approval. If the application is approved at this stage, NoPayNow issues a Home Equity Investment Estimate, or HEIE. This document outlines the maximum investment amount and all pricing characteristics. If the application is denied, an adverse action letter is issued. Step 4. Processing and underwriting. This is where your dedicated NoPayNow processor comes in. They will order title, open escrow, and arrange for an appraisal if one is required. The processor is your LO's main point of contact for document questions at this stage. Once underwriting is complete, a final estimate is issued to the homeowner. Step 5. Approval and funding. At approval, a closing disclosure is issued. After signing, the homeowner receives their funds via wire transfer or check, depending on what they specified to the title company. This is the moment your LO closes the deal. Congratulations. Step 6. Repurchase option. The deal doesn't end at funding. The homeowner can repurchase their investment option at any time within their term. This is typically done through a home sale, a refinance, or a cash buyout. There are no prepayment penalties, no pressure. The homeowner is in control. That is the full HEI life cycle. 6 clean steps. The more your LOs understand this process, the more confident they will be submitting deals, and the faster those deals will close. Next, competitive positioning. Let's talk about the competition. Because when you're presenting the HEI to a loan officer or a homeowner, they are going to ask, how is this different from a HELOC? How is this different from a cash-out refinance? What about a reverse mortgage? You need to have a crisp, clear answer. Here it is. HELOCs and cash-out refinances are credit-based products. They require strong FYKO scores, verified income, and they come with new monthly payments and adjustable rate risk. If a homeowner's income has dropped, their credit took a hit, or they simply don't want new debt, these products are not available to them. Bridge loans, payday loans, and credit cards carry the highest interest rates on the market. They are short-term band-aids, not solutions. Reverse mortgages are only available to homeowners over 62. They come with a rising loan balance, monthly equity loss, and a due-upon-death clause that many families aren't prepared for. Selling the home means forced relocation. The homeowner loses their asset, incurs selling costs, and has to start over. That is not a solution. That is a last resort. Now here is the HEI. No monthly payments, no new debt, no income requirements, no age limit, no impact on their existing mortgage rate. The homeowner stays in their home, they access their equity, and they repurchase on their own terms. Now, is the HEI right for every homeowner? No. If a homeowner qualifies for a traditional HEE lock at a low rate and wants predictable monthly payments, that might be the right tool for them. But for the millions of homeowners who don't qualify for traditional products or who simply don't want new debt, the HEI is in a category of its own. That is your positioning. Own it. Next, use cases to lead with.